So good evening to our stockholders, our guests, our friends. Welcome to the Endeavor Bancorp 2024 Annual Shareholders Meeting. My name is Steve Sefton. I'm the president of the bank, and I'm also a director of the Bancorp. The bank is the wholly owned subsidiary of the Bancorp, and you are shareholders in the Bancorp, not the bank. But you do own the bank through the Bancorp. Just to make that clear. So this evening, we're going to start by electing our directors. We're going to affirm the independent auditor, Ide Bailey. We're going to give some updates on what we've done last year and what we plan on doing in 24 and done so far from our management team. And then Kevin Kuhlman from Raymond James is our featured guest. He's going to talk a little bit about the industry. But let's begin with the legal portion of the meeting. This is the one that you all look forward to. It is 6:20 p.m., and the meeting is called to order, and I've been asked to be chairman of this meeting. And Jessica Lucero from Computershare is the inspector of elections. She's going to oversee the vote. I do want to acknowledge now our directors. So if you would rise when I call your name, and then remain standing until everyone's up. So first, we're going to call Julie Dubik. Where's Julie?
She's standing.
There she is.
She is
Matt
standing.
Ratner. Where is he? Matt. There he is. Same table. Jim Ledwith. Jim. Oh, that's the director's table. Lauren Polger. He chose to go somewhere else. Vicki Turner. Yay, Vicki.
Vicki.
And Chris Woolley at the same table. So Dan Yates and Steve Sefton are also directors, but Jillian Murish and Brian Min are directors who are not attending today. Thank you. You may all be seated. Joyce Glazer, our director emeritus. Will you please stand? Joyce has been with us since this was just an idea, well before we started the bank, and she was there for the whole ride up until about a year ago, I think. So welcome to join us, Joyce. Thank you. You all may be seated. Now let me introduce the executive team to my right. Of course, there's Dan Yates, our CEO. There's next to Dan is Julie Glantz, Chief Financial Officer. Next to Julie is Scott Parker, Chief Credit Officer. Next to Scott is Mark Anderson, Chief Operations Officer. And John Harrelson is the Chief Banking Officer. Who said you only can have one chief? And I'm the president of the bank. So now let me introduce, these are our divisional and department area leaders. Could you please rise? Are they there's a couple out there. They're sprinkled around in here. Stay standing, please. Good governance says you need to be developing your next generation of leaders and the next group in middle management. And this is what this group represents. Thank you, guys. Now remain standing. I want the rest of all of the Endeavor team that are here to go ahead and stand, please. There you go. These are the people that make it happen. Thank you. You can be seated. I'm not going to ask this next person to stand. Kurt Kicklighter, you can just wave. He's our bank attorney, our lawyer from Breakwater Group. And then Era Villafina. Is Erin here? I heard she might come, so she wasn't able to join us. She's our CPA from Ide Bailey. So now we're going to do the vote. So anyone who hasn't voted yet, who wants to vote, we typically have a few every year. Amber, you want to wave back there? Amber at the table back there has proxies, so you can go back there and vote. And anybody who wants to change their vote, if you, for some reason, want to change your vote, there you go. Amber back there. Most of you have already voted online. You voted by phone. You voted by mail. And you don't need to do anything. If you voted already, you're done, and you like your vote. So, Ms. Lucero, can you confirm the shareholder list, and do we have a quorum?
Yes, the list of shareholders of record of the company as of April 1st, 2024 shows that as of that date, 3,421,894 shares of common stock were entitled to vote at the meeting. Notice of the meeting and of the availability of the annual report of the company for the fiscal year ended December 31st, 2023, and the proxy statement for the annual meeting was sent to all shareholders of record on the record date on or about April 10th, 2024. And based on the report of the transfer agent for the company, Computershare. And I do declare that there is a quorum.
Great, and if you hadn't noticed, she's not here, she's attending by phone. So with a quorum present, we can proceed. So we have two proposals up on the agenda. The first is to elect the directors, and the second is to ratify the choice of our auditors, which is Eide Bailly. And all of them are going to serve another year until this meeting next year, where you'll get to vote again. So the board is recommending that you vote for on all of the items for all the directors and for the auditors. You can see your proxy for a lot of details on what we're talking about today. Is there any discussion? So it's now 6:25 p.m. and I declare the polls open. And since there's nobody changing their vote, I'm going to declare them closed. So Mrs. Lucero, can you give us the results?
The report of the Inspector of Election confirms that a quorum is and has been in attendance at this meeting for all purposes and states that with respect to Proposal 1, the 10 properly named candidates receiving the highest number of affirmative votes were Julie P. Dubick, James W. Douglas, Brian Min, Jillian Murish, Lauren R. Folger, Matthew H. Ratner, Stephen D. Stepton, Vicki E. Turner, Christopher J. Woolley, and Dan C. Yates. With respect to Proposal 2, a majority of the votes cast voted to ratify the appointment of Eide Bailly, LLP, as the company's independent auditors for the fiscal year ending December 31st, 2024.
So that concludes the legal portion of the 2024 Annual Shareholders Meeting, and we can adjourn. But that doesn't mean you can leave. The fun part's about to start. But before we begin that, this is my favorite, no, it's not my favorite slide, but this is the slide for the forward-looking statement. You might hear words like anticipate, believe, expect, and the like. We're not making assurances or predictions about the future. We cannot make predictions of the future, and we can't make predictions about what may come. So now, you're welcome to read this if you can see it. So now I'm going to turn over the meeting to my partner, Dan Yates, who will move forward with the presentation.
Thank you, Steve, for the introduction, and good evening, everyone. Thank you for joining us at this year's annual shareholder meeting. I'm pleased to start our presentation with a high-level overview of our performance covering the past year. As we review our past performance, I want to thank you, our shareholders, our shareholders, for your crucial role in our success. As you know, we've achieved significant growth in assets, tangible book value, and earnings, and we've continued to enhance our operational efficiency, positioning us well for future growth. Our annual report theme, which I think you all have a copy of, is resiliency. Over 6 years, we faced challenges. I want you to imagine starting a new bank 6 years ago, and your business model is to target small to medium-sized businesses. This little thing called COVID-19 pandemic shows up, and we shut down the majority of the small businesses in our community. That's tough. What followed next was government stimulus programs, and we were thrust into providing PPP loans for a community, a program that we had never seen before. This team rose to the challenge. No surprise to the economists in the room. Raise your hand if you play Economy 101. What do you think happens when you thrust trillions of dollars into the economy? Inflation follows. What comes next? Come on. Rise in interest rates. Why do I talk about these dominoes? Because boards of banks nationwide are supposed to be paying attention. So let's go back to a year ago, 2023 March, and the headlines, Silicon Valley Bank, First Republic Bank. Bank after bank is failing. Next headline, contagion risk. Who's next? That was the situation a year ago. The media started looking closely at why these banks failed. What did they have in common with Endeavor? Well, one thing was for sure, we were all business banks. I'll tell you one thing about business banks, and most of you are business owners, you tend to keep deposits well above the FDIC insured limits, well above 250. So for the first time in my career, there was a metric being talked about that all of a sudden put us on the bad list. That was, what percentage of your deposits are uninsured? You want to guess what Endeavor had? More than 50, raise your hand, 50%. How about 60? Keep your hands up. How about 70? Okay, yeah, we were up in that stratosphere. That's not good. So banks and depositors nationwide were asked to evaluate the safety of their banks. How many of you have a PhD in evaluating the bank financial statement? I'm seeing very few hands. So what do you do if you can't figure out if your bank is safe? You flee. Where do you go? We had over $1 trillion leave the FDIC insured industry to go into U.S. Treasuries, and in some cases, many deposits stayed in the industry, but they went to the so-called too big to fail banks, banks like Chase with $4 trillion in assets. Our leadership team tonight is going to explain how we position Endeavor Bank to thrive in this environment and seize market opportunities during these challenging times. I want to go back to the beginning, though. We had dinner last night, and I had originally on this slide 2014. Matt, raise your hand. Matt was the one that came up with the idea for a new bank. And it goes back, Matt and Avi. Avi, you here? Raise your hand. And Robert, are you here? These three gentlemen got involved long before I came around, just so you know. It was way back to 2012. We had a lot of fun last night talking about all the different turns and trials and tribulations that happen when you're trying to start a new bank. You know why that's significant? By the time Endeavor Bank was open in 2018, we were the first new bank in San Diego County in 10 years to open. There had been a prior bank in California that opened up. They're gone. They made it about a year. There was a second group out of Irvine that tried to get started. They never raised their capital, never launched. So when we talk about resilience, it begins before we launch the bank. During our formation years, we identified a market need in our community. Much like the rest of our country, community banks have become a bit of a dinosaur. There are fewer today than we've seen any time over the last many years. And we had a particular business model we wanted to introduce to this community. We call it consultative banking. John is going to talk about that model later during his presentation. We set a goal. I want you to look off in the distance on this chart. $1 billion in assets. Why is that significant? As I travel from bank conference to bank conference and I meet community banks, oftentimes, how large is your bank? 100 million in assets, 200 million, 300 million. Then I'll ask the next question. When did you start? 100 years ago, 80 years ago, 70 years ago. So that's interesting. That's a challenge in and of itself. But why a billion? Why is that a goal? As you're going to hear later tonight, and you're going to see some numbers, banks that achieve $1 billion in assets also achieve efficiency, which leads to growth in earnings, which translates ultimately to shareholder value. That's an important message. So what are we looking at here? On your right is a fortress. On your left is a bricklayer building the fortress. In order to achieve that type of growth goal, we recognize that the importance of building a bank to get to $1 billion starts with building a fortress balance sheet. It's important to have a fortress balance sheet as a bank when you navigate difficult economic times. In 2023, we added more bricks to our fortress balance sheet by focusing on priorities that included enhancing our liquidity, slowing down our loan growth, raising capital, and minimizing the amount we invest in bonds. All very significant strategies. The failures of 2023, the bank failures, really required that we look at doing something different to survive the bank contagion risk that we were hearing about. Can you imagine yourself in this little boat in the stormy waters in early 2023? That's how it felt to run a bank last year. When those headlines hit and the media was talking about bank failures, we knew that our balance sheet needed to be reconstructed. So I mentioned we had 80% of our deposits uninsured. You're going to see when Julie comes up in a moment to talk about our financials, we completely flipped that balance sheet. And how did we do it? The team that stood up tonight, these relationship managers, they did an outreach to 100% of our clients that had uninsured deposits. And we offered a product that the banks that failed also had available but did not proactively reach out. That product, IntraFi and R&T, allowed our clients to transition from uninsured deposits to fully insured. Upwards of hundreds of millions of dollars could be covered by simply signing a piece of paper and transitioning to these products. Most banks have these. We took advantage of those products and made sure our clients felt safe. The message last year was clear. If your bank had high levels of uninsured deposits, and if Silicon Valley and First Republic can fail, great banks, by the way, great reputations, then so can Endeavor. So this is why this was a key strategy. How many of you have seen the movie It's a Wonderful Life? Remember Jimmy Stewart? I want to take you back to the scene in the movie when it looks like the picture on the left. Why the picture on the left? When we talk about a bank run, if you're under a certain age in this room, and I won't discriminate, you probably ask your parents, if you're young enough, what the heck is a bank run? Because that's how it used to work. And there were times during the Great Depression when banks did fail from depositors taking money out of banks in a panic like this. Why were you going to the bank? You were going to the bank because you had a password savings account, and that's how you took money out of the vault. And if you thought a bank was going to fail, you need to get there before they ran out of cash. So what changed? Picture on the right. Remember the pandemic? Remember when we couldn't leave our homes? Guess what happened during those years? The largest increase in adoption of digital banking, mobile banking we've seen in our country in years. Out of necessity, more and more Americans signed up to do their banking digitally. So I want to take you back to the prior largest bank failure of a bank due to the deposit run. Does anyone want to guess or throw out a name? You will know. Well, it was Washington Mutual Bank in the years 2008. It's 9 days, $16.7 billion leaves Washington Mutual in a period of 9 days. It's a lot of money. Most of it was done the way you see on the left, going to the bank. Now let's go back to March. March of last year. $42 billion left the bank in 10 hours. Let me give you a perspective. That's roughly equivalent to 1 million in deposits per second, done by your phone. The very next day, clients of that bank requested via digital banking channels another $100 billion. They didn't have it. The FDIC stepped in and shut the bank down. That was our environment a year ago. So what's the tug of war you're looking at? How many of you like profits in this room? Put your hand up. Please, every hand go up. Every hand. Yeah, profits are important, but so is safety. And unfortunately, in our business, they often come at polar opposites. building a fortress balance sheet, building a bank that can survive economic turmoil. Sometimes you have to sacrifice short-term earnings. And that's what we did last year. We employed several strategies. The first was the reciprocal deposit strategy, the IntraFi, the R&T that I mentioned. We also slowed down loan growth. Well, how does that impact earnings? Fewer loans, less interest income, but also it builds liquidity. We raised deposit rates to attract and retain key clients. That comes at an expense. We shifted a significant portion of our clients out of non-interest-bearing checking accounts into money market accounts, again, at a cost. And we heavily invested in technology. And finally, we raised subordinated debt capital, and there's interest carry on that. All of these strategies help create a stronger bank, but they all come at the expense of profits. Anybody have a slingshot as a kid? So what's the movement? You load and you release. Let's talk about the load, because we did the same thing in the bank. Starting in 2023 with our investment in technology, we started investing for the infrastructure to create future growth. We ended the year with hiring significant new members to our team, and we carried over into 2024 with significant investments in staff, including our expansion north. You're going to hear about that and meet some of the team later tonight. And finally, we invested in subordinated debt. Now we're in the launch phase. What does that look like? We anticipate future quarters and well into next year increased earnings because these investments pay off if you execute well. And our intention is to execute well. This is my last slide before I turn it over. But it's a very important slide, particularly for you long-term shareholders. This is our 6-year trend in tangible book value. We have more than doubled your tangible book value in the 6 years we've been in business. Now, normally that's a good thing, and where would you expect to see that reflected? Raise your hand if you asked me at least once in the last week, Dan, why isn't our share price higher? Are we doing okay because the stock's not higher? I hear it all the time. If we were a privately held bank, not traded on an exchange, there's not a single person that would ask that question. Your focus would be on our performance, and you would inherently know that we've created enterprise value. So where is the disconnect? Several factors contribute to this situation. They start with the market sentiment. There's a relatively small number of shares that trade in our stock each year. I want you to think about what would happen if you bought $100 worth of stock at Endeavor Bank at the limit price. $100, probably the next day our stock price goes up $2 a share. That's just what happens when you have a thinly traded stock. It's not a reflection of the bank all of a sudden being worth more than the day before. We're going to do a much deeper dive on this, on these stock market dynamics, when Kevin comes up from Raymond James. That's going to come a little later. Kevin's going to discuss what tends to occur when banks are able to consistently grow assets and earnings over time, and the connection between that type of performance, and when you expect to see it show up in share price. There's no guarantees. That's the forward-looking language. But there are some things we see in the market that I think are worth paying attention to. I also want to add that moving forward, we will be taking further steps to enhance our investor relations efforts to better tell our story to institutional investors and hopefully garner more interest in having them invest in our company. That, too, can have a positive impact on your share price. Now I'd like to invite Julie Glantz, our CFO, to share a detailed analysis of our bank's financial performance, and I'll be back later to answer questions at the end. Thank you.
Adjust this down a little bit. Thank you, Dan, and good evening to all. Now let's take a deeper look at our financial performance for 2023, driving home the results from the journey Dan discussed. Although I kind of think he took the whole show. I'm going to try to go through mine pretty quickly since he gave everything away. We're going to focus on Endeavor's response to the 2023 challenges. Let's begin with our asset growth and asset mix. As illustrated in the chart on the left, our core assets have grown consistently over the last 6 years, reaching $568 million by the end of 2023. We experienced 90 million growth just last year. We're now over halfway to our $1 billion asset goal that Dan mentioned. The chart on the right, let's see if you can still hear me, over here, our chart on the right, this illustrates what we mean when we speak of a fortress balance sheet. You'll notice the small percentage of assets that are allocated to the bond portfolio, which is the tiny yellow slice in the pie there. Only 1.4% of our assets are in investments, while the black section, almost 22%, represents high levels of on-balance sheet cash. The blue is our loan portfolio. We intentionally slowed our loan growth in 2023 to focus more on building liquidity. Again, the black section on there. The advantage for us is we have flexibility. As we enter 2024, we have all this liquid cash that we can invest into loans, where many banks are tethered to loan portfolios that are, investment portfolios or bond portfolios that are underwater. That's holding them back. We're taking advantage. These graphs display the growth in our primary balance sheet components, deposits, and loans. In 2023, we grew deposits 85 million, which funded 56 million in loans. Banks are fiercely competitive for deposits, especially over the last year, as funds have left to go into treasuries. So particularly low-cost deposits, because deposits are the primary funding source to grow a bank's loan portfolio. If I can emphasize one key point, many people believe a bank grows by making loans. It's the exact opposite. Deposits come first, then loans. This graph represents our average loan-to-deposit ratio over the past 5 years. One key measure of a fortress balance sheet is lowering a bank's loan-to-deposit ratio to around mid-80s, let's say, increasing our liquidity. In 2022, when our loan-to-deposit ratio was near 100%, we set a strategy to drive this ratio down by prioritizing deposits over loan growth. As you can see, we were successful in 2023, dropping our loan-to-deposit ratio to about 85%. Of course, there was a cost with that. And as a side note, you can see, if you're kind of wondering about 2020 and 2021, it'll come up again and again on my charts. That was just during PPP, which was, that's where the loans came from, and we had a unique funding source associated with the PPP loans, we'll just say. So different distortion there. Now let's focus on our uninsured deposit pivot. These graphs demonstrate our success. As Dan mentioned earlier, we educated our clients on reciprocal deposits. Prior to the bank runs that we saw in early 2023, people really weren't concerned about uninsured deposits, but the media just took that to a new level, and we recognized right away. I started the Monday after SVB went down. I walked into a board meeting on that morning at 8 a.m. I thought, oh, wow, what's going to happen to this new bank I just came to join? We were sitting at 70% of our deposits roughly uninsured. It's very hard to determine the exact number with uninsured deposits because we just kind of classify everything over $250,000 as uninsured, which is not really the case. But we were able to reduce that to only 26% by the end of 2023. We believe that this produced two key results. First, it significantly lowered the risk of a deposit run on our bank. And second, the safety this provided our depositors enabled us to grow our deposits 20% year over year. Now let's take a look at the deposit mix. So these graphs represent how our deposits are laid out. After a prolonged cycle of low interest rates, the Fed came and raised rates 11 times in 2 years. This caused depositors to wake up nationwide and change their behaviors as they started shopping for higher interest rates. At Endeavor Bank and other banks across the nation, we experienced clients moving funds from no-cost interest accounts to interest-earning, largely money market accounts. Big shift. These graphs show this effect on our bank. At the end of 2022, we had almost 50% of our deposits in free, no-interest checking. By the end of the next year, 2023, that was about a third of our deposits. The deposit mix negatively impacted bank margins and earnings across the industry. So the big question now, is this the new norm? We think it is. We've re-engineered our business plan and our budgets to assume that this is what clients are going to expect going forward. These graphs depict the impact of rising interest rates on net interest margin. The graph on the left shows our interest income in blue. Interest income being what we earn on our loans and investments or cash, overnight cash in our case, which is at Fed funds rate. The orange represents what we pay on deposits. As we just said, as deposits shifted into interest earning and Fed raised rates 11 times, that created the surge you see in 2023, that orange bar. That was a very significant impact to our bottom line. However, it was a strategy for us to stick with retaining our deposits and growing deposits during this difficult time. On the right, you can see the impact on our net interest margin. We finished 2022 with a net interest margin at 4.05%. By the end of 23, it had dropped to 3.75%. That equates to about $1 million in net interest income had we been able to hold that net interest margin at the just over 4%. But we were comfortable with our decision and our strategy to retain the fortress balance sheet. This brings us to my final slide. This graph focuses on the lower section of the income statement, the non-interest expenses or overhead, and pre-tax net income. On the left, the significant increase in overhead in 2023 was primarily caused by, like Dan said, investment in technology and an increase in salary expenses as we hired more people as the organization grew. Pre-tax income increased from $4.4 million in 2022 to $5.5 million in 2023. This was largely driven by our asset growth, and this helped us offset the decline in our net interest margin described in my previous slide. In a year characterized by major bank failures, deposits leaving the industry, and net interest margin compression, we were able to grow our balance sheet and earnings. We think we are very well positioned to leverage our new capital and grow our future earnings. Now, a little bit later, Steve's going to share the details on that. But first, I'm going to turn this over to Scott Parker, our Chief Credit Officer, who's going to talk about our credit quality and loan portfolio.
Good evening, everyone. Oh, I need to bring this up. I'm a little taller, a little bit. Good evening, all. Thanks for being here tonight. I can remember when it was always loans that were the problem for a failing bank, and that's what caused problems. It's a whole different world now. We used to not think too much about underwater bond portfolios or liquidity issues. It was always loans. So nevertheless, loans for us are very important. As you saw in the previous slide that Julie shared, they make up the vast majority of our earning assets. So pretty important to have good credit quality along the way. I'm going to share a little bit of information about our portfolio. Some of it is just to somewhat set your minds at ease, maybe, differentiated us from some of the news that we hear out in the market about particularly commercial real estate. And a couple of characteristics and charts and graphs to share. It wouldn't be a bank shareholder presentation without lots of charts and graphs. So this represents the last few years of our non-performing loans. Non-performing loans meaning loans that are past due, specifically loans that are 90 days past due. And it's a number that gets reported to the regulators. It's in the bank call reports, so we can look at ourselves and other banks and see how we're doing. Our bank is represented by the blue bar in this graph. The orange bar, or yellow bar, whatever that is the average peer group in California, other banks in California. So you can see that, generally speaking, our non-performing loans have been significantly less than our peer group over the years. Obviously, there's a blip there at the end of 2023 that actually represents one loan that fell delinquent at the end of the year and was subsequently brought current in the next month. So we had a blip there. It's unfortunate that it happened to be on 12/31, but there it is. So it kind of throws us for a curveball there. But you can see we returned back to our historical norm in the first quarter of this year. And that's been the way the bank runs. I've worked for a lot of banks in my career. I've worked for banks where every day we'd get a report of past due loans. And some of those banks, those reports were pages and pages and pages. We don't have that here. So it's very refreshing. I think it's part of an offshoot of our culture and knowing our clients and having those relationships. How we protect the bank against future loan losses, there's a term called ACL, which is the allowance for credit losses. And it's essentially a savings account that we set up and we fund it and we grow it as the bank grows. And it acts as a cushion against losses for loans that deteriorate in performance and eventually get charged off. You can see here we're a little over $6 million at this point in our allowance for loan loss. It's essentially a savings account. Every time we make a loan, we take part of it and we put it in this bucket, if you will, and we set it aside for future issues and future problems in the portfolio. And as you can see, we've been pretty consistent at about 1.5% of the portfolio as the amount of our loan loss reserves. Again, another blip in 2020. During that year, it was a little uncertain what was going to happen. And we prudently stepped up our loan loss reserves just because no one knew what was going to take place as far as the economy, as far as business performance, and subsequently our loan performance. So it jumped up a bit there and worked its way down back to the more historical norm as time went by. One of the things I think has been key for us in our performance is the consistency of our loan portfolio. If you'd seen this chart last year and the year before that, and maybe some of you probably did, the dollars would have been different, but the percentages that are shown here would have been almost the same. We've been consistently doing loans, and our portfolio is represented about a third in commercial industrial loans, which are loans to operating companies, a third in owner-occupied real estate, which is essentially the buildings those companies are housed in, and non-owner occupied real estate, which is investment property. This really hasn't changed over the years. To dive a little bit into the real estate portfolio portion of our overall loan portfolio, I highlight this just to kind of show what I think is a differentiator from what we hear and see in the media today. There are almost every day there's a report of a large office building that has, was worth $10 billion and now it's worth $1 billion and somebody's taking a big loss on it. Sometimes it's the property owners, sometimes it's the lender. We don't really have any of that kind of property. As you look at this graph, you can see that more than half of our real estate portfolio is owner-occupied real estate. So these are our clients. These are business owners. This is the real estate where their companies are located. And not only that, we have personal guarantees on virtually all of our loans, commercial, industrial loans, and real estate loans. Our portfolio overall, real estate portfolio, both owner-occupied and non-owner-occupied, has an average loan-to-value of less than 60%. And so we've got a nice cushion as a moderator against deterioration as far as real estate property values go. There has been talk a lot recently about repricing risk, and that is an outgrowth of the change in interest rates that we referenced previously. If you took out a real estate loan 5 years ago, you had a very nice low interest rate. And when it's time to come and refinance that loan, or it matures and you've got to go refinance it, you're going to have to do so at a higher rate. And so clearly a big concern out there in the market, not as much for us, and I'd like to say it's just because we're brilliant, but it's really mostly due to our age. We simply haven't been around that long. Most of our portfolio hasn't reached that point in its life cycle. We've got about 13% of our loans that are going to be either maturing or repricing by the end of next year. And it's a very manageable number. They're all clients and they're companies that we know, and we feel comfortable that they're going to be just fine when it comes time to address that maturing loan or the repricing. And part of what we do also is just ongoing risk management, which is in our real estate portfolio, we look at every single loan over $1 million, at least annually, sometimes more frequently than that, to determine the risk there, to make sure that there's capacity to keep up with the payments should they have to refinance that loan in a higher interest rate environment. So we feel like this is something that makes us significantly different from everything we hear in the media these days as far as CRE loans and the trillions of dollars that's out there that's going to be the next shoe to drop in the financial world. We don't have any of this type of property. This is mostly what we hear about in the media. Large loans, typically investment property. There's no personal guarantee. There's no person standing behind that loan who is responsible for it. We simply don't have any of this kind of property. We have about less than 10% of our CRE portfolio is office product. And it's really not this kind of office product. It's office buildings in Miramar and Escondido and Poway. Again, over half of it is occupied by our clients. So it's a very different picture. It's a very different scenario than everything we're hearing about in the media today. So I just kind of wanted to share that with everybody and make sure that you understand the kinds of loans that we're doing are generally different from what we're seeing out there in the marketplace. Not to say that there aren't problems. There are absolutely problems, but they're not Endeavor Bank problems. So I think that's important to share. That's all I have to share. I'll be around for questions later on, just like the rest of the panel. And I'm going to turn it over to Mark Anderson, our Chief Operating Officer, who's going to talk about technology that underpins our banking system.
Thank you, Scott. Good evening, everybody. Resilience is innovation. Resilience is innovation, and innovation is the act of introducing something new. We at Endeavor were constantly looking to innovate and improve our banking technologies and remain at the forefront in our offerings. Quite a daunting task. How do we do that? How can Endeavor Bank match up against the big boys? Well, this is accomplished through partnerships with technology firms. Our primary technology partner is a company called Jack Henry & Associates. Brief background on them, they've been in business for over 47 years, and they're considered one of the big three banking technology providers. They provide services to over 940 banks, ranging in the de novo size, which we were back in 2018, up to banks as large as $50 billion in assets. As a partner of Jack Henry, we get the benefits from their almost $143 million that they invest in research and development during calendar year 2023. So in providing their technology solutions, Jack Henry's been innovative, and they've moved away from their one-stop shop and has instead pivoted to a best of breed. What does that mean to Endeavor? Well, it means we no longer must obtain all of our technology solutions through Jack Henry. Instead, we can align with any technology vendor that we feel best fits our needs and the needs of our clients. Jack Henry has made that possible through the usage of open APIs, allowing the integration of non-Jack Henry products into our core banking system. This allows Endeavor to align with any top service provider, allowing for the integration of products and services that can match or even surpass the technology of the competition, and that's even the big boys. So let's take a look at some of the technology investments that we made in 2023. As the panel has said, the building of a strong foundation was imperative, and we did that with our products and services, and that was a driving factor behind our 2023 technology investments. The results of those investments included a new accounts digital platform, a loan origination digital platform. As you've heard just about every speaker up here discuss the expanded FDIC insurance product. And just a little bit of information on that. That product that Dan was referencing allows each depositor to have $150 million in insurance. We proactively called all of our clients in 2023 that had more than the $250,000, meeting the client's needs for a flight to safety. Real-time payment network. That's where funds are sent, received, and processed within seconds. We improved our data analytics tools, going from a manual system to a system that allows us to get quick and accurate information at the push of a button. We opened a new full-service branch in East County, allowing us to serve our clients in the La Mesa and surrounding area. We also rolled out a remote cash vault service solution where we partnered with an armored car service to handle all the cash needs of our cash-intensive businesses. So 2024, looking forward, to navigate that technology maze, we developed a technology roadmap. This roadmap allows us to look forward, prioritizing the technology innovations that we plan on investigating and potentially implementing in the future. So here's some of the items that we're looking at for 2024. An upgrade to our business online portal, focusing on the small to medium-sized businesses. In the payment card industry, we're going to issue contactless debit cards, automated debit card activation, as well as offer an improved credit card solution. FedNow, that's another real-time payment network, and it specializes in government payment transactions. And we also have Secure File Transfer Protocol, which is a file transfer service that is geared towards the medical industry as it's HIPAA compliant. So with our technology foundation in place, there's no better time than now to bank with Endeavor Bank. The man leading our team to promote the benefits of being a client of Endeavor is our Chief Banking Officer, John Harrelson. John, the floor is yours.
Okay, there's no graphs in my part, so. In the next few slides, I want to dive deeper into what I see as our key advantages and challenges. This will help you, our shareholders, understand what is driving our success. It will also show how my role as Chief Banking Officer supports our team's efforts to grow our business, both with existing clients and new clients. Growth is a primary driver of our profitability, and why we want to spend a little time this evening talking about it and describing how we see the bank competing in our markets. Allow me to introduce the production team that makes the growth happen. These are the individuals that make up our team. They're charged with caring for our existing clients and finding new ones. This team is the engine that drives our growth. Our 18 team members are organized into 4 teams, 3 here in San Diego, 1 up north, which Steve will discuss in more detail. The team's expertise is largely centered in targeting mid-sized, owner-managed businesses in a wide range of industries, which include manufacturing, distribution, medical, legal, construction, government contracting, nonprofit, and many others. Our plan is to add even more engines, production team members, to fuel our growth. Here are some highlights. We had a very strong loan and deposit growth in 2023. We cultivated over 75 new relationships last year while supporting our existing clients. We recruited 11 talented bankers to our team, 3 last year and 8 this year, 3 of which are in our northern market in the Los Angeles area. This is what Dan means by the slingshot effect. Now let's examine our why. What attracts businesses to Endeavor Bank? It all begins with our consultative culture, like many of you know. It's our primary value proposition. It's our secret sauce, as some say. We brainstorm ideas, solutions, and make key introductions to other resource partners to help clients grow revenues, increase profits, solve critical business issues, and to identify and capitalize on opportunities. I have almost 35 years supporting the San Diego business community, and many of our team members have similar backgrounds. All that experience translates into a deep well of insights to share with our clients. Our overriding key advantage that stands out to me is our ability to make quick local decisions. Because our decision makers are accessible and responsive, and many of you know that, setting us apart. This is unlike large institutional banks that sometimes operate like the picture on the left. Endeavor Bank is a business bank primarily owned by business owners and influencers within our community. This unique ecosystem is vital to our success. Our board, executive team, and client relationship team collectively leverage their respective networks and experiences to benefit our clients. This collaborative approach facilitates opportunities and solutions which many of you in this room have probably experienced. We brand our consultative banking and relationship building initiative as the club. Regularly, we bring our club members together for educational and networking programs, featuring valuable presentations by subject matter experts. This event gathers business leaders from various sectors in Southern California, creating a powerful networking opportunity. Members reconnect with past contacts, find new partners, drive business to the bank, resulting in an incredible amount of positive feedback. Membership is by invitation only for business owners and bank shareholders. The team is actively engaged in the community through business associations and networking partners. Here's a few of the ones that we're involved. We broaden our knowledge and become more deeply connected with our customers and referral sources by involving ourselves with these associations. Industry and professional organizations also allow us to connect with peers of our clients, as well as professionals that actively refer clients to the bank. business founder and CEO peer groups have been great supporters of Endeavor Bank, and we want to thank you for that. We're also proud supporters of the nonprofit community. Here's a partial list of nonprofit organizations we support. We focus on giving back to nonprofits with time, treasure, and talent, and supporting their missions. Many of our clients are board members or even founders of some of these organizations. I would like to now pass it over to Steve Stefton to talk more about our 2024 strategies.
Thank you, John. So you've done great, audience. I'm going to try to bring it home and go through this, and you're doing well. So this slide indicates, obviously, that we have a growth strategy for 2024. We're going to talk a little bit about the market conditions, what going on offense looks like, and how capital is related to that. So what was the landscape like? So imagine you're with all of this management team and with the board for our strategic planning, which went on late in September, the last week of September and the first week of October. You're a fly on the wall, you're there watching. First thing we developed were what were the conditions that we were faced with? Well, the first thing is that you've heard about bond portfolios being underwatered. Many banks were saddled with these bond portfolios that were just a weight around their neck as they tried to run the race. It was the most tumultuous year in banking in over a decade, as long as I can remember. The failures earlier in the year it just created a crazy environment. We're all aware of that. There were earning pressures from every direction against banks, and it was just a really difficult time. We all heard the financial press with all the chirping online about, were we going to have a recession? Were we not going to have a recession? Is it a soft landing? Is it not? It was very uncertain. This middle one about the deposit outflows is not intuitive. One of the shareholders in the room sent Dan and me an email earlier this week, and it had some great industry data. Thank you, Don. And I pulled out a slide in that deck that he sent, and up through September of 2023, for the preceding 6 quarters, the banking industry as a whole lost $1.4 trillion in deposits. Think about that. $1.4 trillion in deposits. I'm not aware of that ever happening to that degree ever. It was enormous. So what do deposits mean to a bank? It's our funding source. So if your funding source exits, your balance sheet shrinks. It's like letting the air out of a balloon. That's on the liability side. What happens on the asset side where you make loans? It has to shrink too. How can a bank that's losing deposits go on the offensive and grow and make loans? It makes a really tough environment. So if that was the industry as a whole, not all banks, but a lot of banks. So what do? They get very defensive. They hunker down. They don't want to grow. They want to wait. They want to hold back. What does their talent do in the face of that situation? It starts to get jumpy. It starts to leave. I see a head shaking right there from one of them who joined us during this time. It was the best time since we've opened the bank for having that much talent willing to consider joining us. And it turned into a great time to go on the offensive. So what was our offensive strategy? Well, we decided to be a contrarian. You've heard a little bit about fortress balance sheet, have you not, tonight? We had been working on being in a strong position. We were playing from a position of strength. Who remembers what Julie said about how much we grew deposits in 2023? Does anyone remember? 20%. In the face of a shrinking banking environment, we grew. We invested in depositors. We grew 20%. We were positioned to grow, to be a contrarian, like I said. So all of you got a press release a few months ago about an expansion into the LA Inland Empire market. If you were noticing your inbox, that's part of our growth strategy. But that's not the only growth strategy. John told you about hiring 11 producers in the production group very recently. Only 3 of those are up in that market. So most of the growth is planned for here in San Diego, the local bank. It's our core growth strategy. But I am going to talk about going up north because that's new. So why did we do it? Well, it was a talent that was available. Duncan, you want to wave to the crowd? Duncan leads our initiative up north, and he put together a great team. It was, again, the talent was available. The other reason to do it was the economy. LA, Inland Empire, Orange County, that's one of the best economies in the country. I think the data will show that. And then experience. Dan and I have a combined 50 years of experience in that market. We know it well. It's a target-rich environment. We have the right team. It was a great time to move. It had always been in our strategy since before we started the bank to eventually be up north. It's a well-worn path of successful San Diego banks going up north and doing well. And we think we've got a great launch going that we will do that. But what's the raw material for doing this? It's capital. And when you think about forms of capital, we could have done another common stock offering, but the cheapest form of capital, the most inexpensive, I should say, form of capital for you shareholders is for us to maximize how much subordinated debt we can borrow. So we borrowed subordinated debt because it was best for our stockholders, because it's non-dilutive. You don't get diluted because of a subordinated debt capital raise. So what did it look like? The holding company was the borrower at $12.5 million. The term was 10 years, the rate 9%, and it's callable in 5 years. So what are the economics of this? Well, the holding company downstreams $10.8 million to the bank, is new capital to the bank. Tier 1 is what we call it, primary capital. The interest on the debt was $1.1 million. The bank ultimately pays that, but we held a $1.1 million interest reserve up at the holding company to pay for it in the first year. This middle point is really key. Now I'm going to talk about a theoretical bank that might do a capital raise of $10 million. What's the key point of it? It's that leverage piece, 10 times leverage. Regulators are kind of funny. They kind of like to manage the capital levels of banks. That's a very important thing to them. And why? Because you've got to have a right amount of capital to be safe. So 10 times leverage is a good leverage factor for a bank to stay within the regulatory guidelines and grow a bank. You can't grow an unlimited amount in a very fast speed without the regulator stopping in and stomping on the brakes. So if we're going to implement a growth strategy, we're going to need to raise capital to make it happen. So if a theoretical bank raised $10 million in capital and leveraged it 10 times, and what would that mean? They would go out and raise $100 million in new deposits. And then they would invest those $100 million in new deposits in what? Earning assets. And what's a bank's primary earning asset that you heard tonight? Loans. Wow, you are good audience. Loans. So we're making loans with that. And the interest we earn on those loans minus the interest we pay on the deposits creates what we call net interest income, or you heard Julie talk about NIM, net interest margin. And this theoretical bank would probably target 4% as their return after paying for the cost of the deposits on making money on that $100 million. So if I went over to UC San Diego and found a finance professor and asked him if I could make a $4 million return on a $10 million capital investment, is that a good return? That's a pretty good deal. That's why you do this. It's leverage. Banking is about leverage. That's what turns $10 million in capital into a great deal for this theoretical bank. So now I'm going to connect to every year. If you think about Dan's slide of the slingshot, loading the slingshot is capital. It's people. It's technology that Mark talked about. And then when you launch that slingshot, you got to execute, bring in the clients, bring in the deposits, bring in the loans, and what does that lead to for this theoretical bank? It should lead to earnings. And that's where we turn it over to our guest. So Kevin Kuhlman from Raymond James is our guest, and he's going to talk about what steady growth can do for earnings and stock price. Kevin?
Appreciate that. I'm going to need about an hour and a half to get through these 4 slides, so in all sincerity, thank you to Dan and management and the board for inviting my Raymond James colleagues and I to this. We're honored to do that. I'm kind of here, just a 10-second background for me. I'm back on the investment banking side. I say back on that. My prior 16 years I spent with a private equity fund in Philadelphia, Patriot Financial Partners, where we made investments in community banks like Endeavor, and was doing that for about 16 years. So the slides I want to work through, I promise, quickly. What I'd like to do is kind of take the approach of what you heard here is a tremendous story. And there's a lot of detail as to where the bank has been and where it's going. What I would like to do is try to validate all that with what's going on in the marketplace right now. And this isn't just management doing a nice job and throwing up pretty numbers and whatnot. My colleagues and I see a lot of banks throughout our careers. I'm here to tell you that this is a great opportunity. We're all frustrated about the bank's stock prices. I still have a big interest in Patriot. I'm frustrated with you. The reality and what you need to look at here, though, is how are we set up going forward? So I'm going to try to link what the management team here has done rather quickly with what's going on in the market and why you should all be very excited about the opportunity you have and really the way the bank is positioned for the next 3 to 5 years. So a lot of details on these slides. I will summarize a lot of these for you here. What we try to do here is just kind of show you what you all know, Endeavor's valuation versus peers. And these are OTC listed company and peers. You can see going back in time, we took this through 2021, I believe here. And right now we're trading at about 89% of book. Peers are about 83%. Earnings, not quite as relevant right now with what's going on with community banks. So why is this slide relevant? Well, what's going on in the marketplace right now is bank investors they're struggling right now. They're frustrated. They don't know. There's a big overhang right now on credit. If one bank has one loan that goes bad, the assumption, I'm telling you from experience, is, well, the rest of the portfolio is shot. That means there's a lot more issues. You heard a lot of detail tonight about how management takes care of the portfolio, is very thoughtful about it. You don't have the office exposure that others do. So I'm telling you all good things, and you're all looking at me saying, yeah, but we're still trading at 89% of book. What the heck's going on here? So we will try to move through this and give you a little bit of an explanation. Wanted to quantify for you, this slide is interesting. We took this back through 18 when you were formed, and we want to look at where has the stock price gone? You're all familiar with that. But what has happened with tangible book value? And what we at Patriot used to do and what we talk about a lot with banks is if you grow tangible book value, you're doing your shareholders right and proper. And that's what management can control. There are a lot of levers to do that. You heard a lot from management tonight as to how they're doing that. What's interesting here is you can see the light blue line, and the point down there, there was the drawdown. As you formed the bank, you started to grow, you made investments, you drew down on the capital. The price came up, came down. It's a little bit all over the place there, but keep in mind you don't have a lot of float. By float, I mean your shares aren't in the hands of a lot of shareholders. That can be good, can be frustrating, can be bad. Right now, as an example, today the market got clobbered. I think we all know that. Bank stocks in general were off 3%. Your price didn't move. That's a good thing. What's important about this slide is if you take a look, I'm pointing right here to December 19, you can see an inflection point. And if you did the math, so wherever that UC San Diego professor is, did the math, and you took a composition and calculation as where's tangible book gone from that inflection point to today, management and the board has been able to grow tangible book per share over 16.5, almost 17% per year. And that is critical and very important, again, for investors to see where is this bank going. And I'm going to tie that together with the final slide. But you can see here we're frustrated about the stock price. All bank investors are. I'm here to tell you shouldn't be as frustrated as many are. We're doing a great job. You've heard the details about where the bank is going.
and you're growing tangible book. That's critical from an investor's standpoint. Okay, lots of data here I'm going to summarize. What we tried to do here is quantify. Our firm does a lot of work on the research side of what drives shareholder value and market valuations. So if you look at the scatter plot here, what the heck does that mean? We took a regression analysis, so again, the stats professors here, and said, what really drives valuation? A lot of things can do it. If you take a look at that data in detail, I'll summarize it for you. There's an R squared or correlation, 52% of if you grow return on tangible common equity, the correlation is 52% to your valuation. So what does that mean? Grow tangible book, grow profitability in terms of ROA and ROE. Your stock price should go up theoretically and valuations improve. So a little detail on that. Whoops, let me go back here. This slide on top, we took a look at ROATC, return on average tangible common equity by asset size. And as you can see in the chart, as you get larger, you grow scale. These banks tend to drive higher returns. They perform better. Scale is critical. We heard the target here is to get to $1 billion after 10 years. That's a great goal. You're well on the way to that. That will drive, scale will drive. So you're going to hear in the next 2 minutes when I wrap this up a lot about scale and the importance of that. The chart on the bottom actually will show a little bit different measure. It's an efficiency ratio, looking at your expense side, the non-interest expense, and as management indicated, okay, we've made investments, now we're going to grow into that, and that's going to translate into results. As you can see here, as the banks get larger in size, they get more efficient. Efficiency turns into profits. Profits, as we now know, turn into ROA and ROE. Your stock price is rewarded. Is it a perfect correlation? No, nothing is. The market is tough right now for bank stocks, but the general answer is you're on great footing right now, and you're well positioned to scale up. You have the infrastructure, you've made the investments, and now management and board are focused on turning those investments into results by scale. Just taking a step back, since we looked at, you were de novoed in 18. There were 6 de novo banks organized in 2018. So I wanted to take a quick step back and say, how do we look versus the peers who de novoed in 18? In general, what this slide is going to show you here is de novo activity tends to follow what's going on in the marketplace. Times are good, we form banks. I can't tell you how many de novo opportunities I saw at Patriot, and we did one, actually. It's a tough model to follow. It's what we call a J curve. You take a lot of expenses up front. It's tough to get your returns out. It's a tough model. You've been here now 6 years, growing very, very well in great markets. Not every de novo enjoys great markets. You're in fantastic markets. So this just tends to take a look at where was the de novo activity over the years back to 18. And as you can see, it generally tends to follow what's going on in the marketplace with the economy. We advance this here again, a lot of data. I'm going to summarize it for you quickly. It shows Endeavor's performance against the 2018 class. You've done a great job growing the balance sheet, as you can see, well ahead on loan growth, asset growth. We're there. We're 6 years in. That's tough to generate profits for any 6-year-old bank, quite frankly, at this point, but you can see very good trends here, and in terms of where we're positioned. Some of you might look at that and say, well, okay, well, what does it really mean? Here's what it means. Management and the board went out Q1 this year and raised capital. So I'm going to put my private equity hat on again. That is very challenging to do right now in this marketplace. There aren't many banks out there that can really come to investors, especially institutional investors, and make the story, here's why you want to put money in my bank. The fact that management was able to go out and successfully raise capital, kudos to them, the board, shareholders who invested. That's what you see. We wanted to hear a really solid plan, well-focused, but this is critical, management who can execute on that plan. Lots of folks have business plans out there. What you want to see as an investor, trust me on this, in bank stocks or any sector, how do you execute on that, and can you make that really happen? And I think what you've heard tonight in detail from management, I'm trying to tie it all together, that has happened, and I think it's going to continue and only accelerate at this point. This isn't me as an investment banker talking. I'm wearing my PE hat again right now. One of the critical parts I think that investors need to pay attention to, and this is very interesting, is we've seen interest rates go up and down. So we wanted to kind of look at Endeavor's performance versus peers versus a regional peer group. So it's West Coast banks, 500 million to 600 million, similar in size to you. And what's happened to the net interest margin? That's the NIM that you see up there. Julie mentioned this earlier. The NIM is critical for community banks. You don't have a lot of different revenue sources. Your primary source of income comes from the net interest income, the difference you earn on loans and deposits. Endeavor is the dark blue bar in each of these. And as you can see over time, you have historically, not necessarily in the first year in 2019, but follow after that, historically outperformed your 2018 de novo peers along with your West Coast peers on the net interest margin. That happened during rates coming down, rates coming up, and starting in 2020, 22, you've only accelerated that growth. So that is critical for bank investors to see how are we going to generate returns here. And the numbers that you heard earlier, net interest income, net interest margin is the way to do that. That's the one critical thing you can focus on as a management team for a community bank. And as you can see here, you're driving that very, very well right now, which should in turn drive ROE. Again, coming back to that, where does that go? Stock price. Almost done. Scale and valuation. So just to drive home, okay, scale, that's great. Where are you going with this? I think this is an interesting chart. Again, this takes a look at where are banks based on size. So we have the smaller banks down here, less than $1 billion, all the way up to the bigger guys, greater than 50 billion. And we took it over a 3-year period, which is the dark blue, 1-year period, the middle blue, and then current. And we took a look at, based on size of the bank, how are you valued? And you can see the general trend here is the bigger the banks are, the greater the value. It goes up, it scales up almost linearly over time. What is also interesting, a little bit more subtle here, without digging into the weeds too much, if you look at the middle bar and the light blue bar there, you can see over the year ago period and current period, for the smaller banks at this end, we've kind of stayed at the same. So no one's happy at 89% of book or 80% of book. We're all there. And guess what? We were there a year ago. So not much has changed. As you get to 5 billion and up, you can see middle blue bar, light blue bar. So we've actually increased valuation over the last year. Again, emphasizing the importance of scale. Where we are right now, that's going to be critical for the bank going forward. So again, scaling up tends to lead to larger valuations. You're a much more efficient institution. Last slide. All right. Additional benefits of scale. We've kind of hammered this home. Scale drives greater efficiencies. Efficiencies improve ROA and ROE, and that tends to turn into increased share prices and valuation. A little more subtle strategically on scale. What does that really get you? Top bullet point here, improves a bank's ability to attract institutional capital. If I go back to my Patriot hat again, apologies to my Raymond James friends, but a larger bank can raise capital more easily. I, as an investor, didn't want to put $2 million to work. I wanted to put 20. So ownership levels are important to the regulators. The larger you get, scale up, it's easier to attract institutional capital from an ownership perspective, as well as, hey, I've demonstrated my growth, I've grown the bank, it's a lot easier. Reiterating again how kudos to management and the board for raising capital in this environment at the size you are now. That's to be commended. That is fantastic, as that is a very hard thing to do. Last bullet point, and I'll be finished and wrap up. It increases, if you choose to do so, and I'm not saying you should, if you wanted to pursue M&A, scale obviously facilitates M&A. How so? The larger you are, it's easier to do an accretive transaction. I won't get into wild language on M&A. You're less dilutive to your shareholders. It really does make doing M&A easier. We talked about sports and being on the offensive. You are on the offensive. You do not need to pursue M&A to grow. the markets you're in, the people you have driving the growth at this bank, you don't need to do that. If you did want to do it, scale would help you do that. So I would just wrap up by saying, again, appreciate the opportunity to talk here and meet a lot of you folks. I'm happy to answer any questions as well, but I know it's tough being a bank stock investor right now, but from a third-party perspective, you're in a very, very good position with this board and management team. So congratulations, and thank you again, Dan. Thank you.
Let's give Kevin a big hand. Well, now it's time to turn this over to all of you. As we do every year, we now open it up to questions, and everyone on the management team and Kevin is available to answer anything that's on your mind. So who would like to begin? Don't be shy. I planted people in the audience.
Back over there, Dan.
Kevin Casey. Oh, great question. How many of you know that we issued our first ever stock dividend? 2%. The mechanics are for every share you have, you're going to receive 20% shares. 2% of the shares will be issued to you in stock. Some of you may turn around and sell those shares for cash. Most of us will probably retain those shares. So it's a way to return capital to our shareholders, and it's been very well received so far.
Let me jump in and say, because I've heard this question asked, it's not a cash dividend, it's a stock dividend. You get 2% of the stock that you own, not cash.
And when does that show up?
Julie, what's the record date?
May 20th, this past Monday. So those of you that have not, you'll probably be receiving your letter with your statement tomorrow, I'm guessing is the date. Those went out Tuesday.
Neil.
Kevin took my question, but I understand the extra 2% creates a little bit of liquidity in the event shareholders decide to sell that additional 2%, but you already have a really thinly traded stock. So why do that?
It's really to reward the shareholders, because what you typically find in a stock dividend is a stock tends to bounce back pretty quickly after you issue it if it goes down at all. So basically you have more shares, the same price over time, if that happens, and therefore it's a reward to you. In addition, like you said, it's more stock trading in the marketplace, creates more liquidity and opportunities for investors to acquire stock. As an example, many of our employees have reached out recently and said, we'd like to get involved in buying stock. So that's a way that we can create more float. There are very few shares traded over the course of a year. So unfortunately, or fortunately, most of our shareholders that bought stock in 2018 are not willing to let them go. So issuing more shares allows for more trading activity. That's the hope.
I think most of us are in that boat. We all see the same faces for the last several years. How do you increase the number of shareholders without increasing our shares? We need the public to trade, right? Not just us.
It's been interesting. Over the last couple of years, we've had two institutional investors very quietly, not very visible, acquire shares in our bank. One's accumulated 4% of the bank's stock, and another is approaching about 3.5%. And they usually show up at my door after they've achieved a significant ownership position to announce that they've acquired that position. And I typically ask the question that you asked, how did you get these? And that's part of their secret sauce. It's 100 shares here, 200 shares there, very quietly, very consistently through market makers. Kevin may have a better idea of how that happens because you've been with Patriot Officer, and if you want to come up and address that at all. But it is very interesting that it doesn't show up on my radar until they've accumulated a good position. You want to address that, Kevin?
And while he's getting the mic, we've also hired a financial PR firm to get to all of the conferences and out and pitch our story. We need to get our story out.
That is important. I will say we would accumulate shares quietly through market makers. We make a market in your stock, so you know who the market makers are as an institutional investor, and they know where the shares are, meaning they know who wants to sell, who's interested in selling. So we would typically work with market makers to accumulate a position. We would tend to take bigger positions, so we'd be upfront with management, making sure they and the board knew what we were doing. But you can accumulate shares quietly, or you can work with a firm who is a market maker in your stock to do that. And to address your point, I've been on several boards where it's a similar issue. It's frustrating that shares are held, even in bigger companies. You have, let's say, 3 or 4 large shareholders who control the shares. They don't trade. So it's not just smaller community banks. It can be larger ones too, that if just limited float, you're just not going to see those shares, kind of move around a lot. Best thing I can say is working with market makers. They know where the shares are and where the activity is.
Great question, Neil. Thanks. BJ.
Not so much a question, but just a comment. Congratulations to you and the team. What a great job during a lot of turmoil to have navigated and taking a aggressive offensive position, yet being responsible. And it sounds like the strategy you have with IR coming on and things is very positive. So congrats and good job.
Thank you. I appreciate it.
Thank you.
And the team is happy to answer questions. You can direct it to the studious crowd.
Hi. How are we doing since we're halfway through 2024 almost? How are we doing?
I'll let Julie answer that.
Oh, wow, that's a big one. So it's been really exciting. The first quarter, a lot of the investment we put into our people reflected on our income statement. The pipelines we're seeing, the expected growth, the second quarter, as we're halfway through second quarter already, the numbers are coming in, and I'm really excited to see where it goes in Q3 and 4. I think that we're going to exceed our budget. The slingshot effect that we talked about is coming.
I don't think my lawyer will let me talk about the current results until they're. He's
No,
shaking
he
his
won't.
head.
I
can't
think
talk about the results until they're public in June. So we can talk about March, but I can't talk about now.
Theoretical.
What I'll add
I
to,
can talk about a theoretical bank.
here's what I will add.
He's not liking this.
You've heard a lot tonight discussed about NIM. For your businesses, you might think of it as your gross profit margin. It's very critical for a bank. And what has happened in the industry, by and large, is we've seen the cost of deposits starting to hold. Maybe you've seen headlines, will interest rates stay higher for longer? Depositors, unlike last year, are not coming to us daily asking for higher rates. So as we start to see rates stabilize on what we pay for deposits, on the flip side, we're booking more loans at an ever-increasing rate at higher yields. So what that's doing for the first time is it's starting to see our margins expand. We reported that in our first quarter earnings, so that's public information. I make sure my attorney knows that. And who knows what the future holds. But I would suggest it looks good.
Hello, Dan and Steve and team. Nice presentation.
Thank you.
Haven't heard anything about AI, so could you guys speak to that? Is it a defensive position, an offensive position? How does the bank view the opportunities and threats of AI?
So that ball is in my court, and I proceeded to bring a lot of other smart people that know more about AI than I do involved, and we're developing a strategy right now. As you know, we use EOS as our management system, and it is one of our annual goals to have an AI strategy in place by the end of the year, and we're working on it right now. Mark talked about Jack Henry. All of our providers are implementing AI, so we're getting AI boosts through all of the vendors that we use. I would say all is in quotes. It's certainly our core vendor, Jack Henry. So AI is coming to us as we speak through particularly our core and our vendors, and we're developing a strategy right now. We're picking off the low-hanging fruit that we think we can execute on immediately, and there's quite a few projects involved, both on the production side and on the client servicing side. So we are definitely not going to be left standing still.
And I bet if I took a survey in this room, the room would be divided. We have those who are fearful of what AI means for the future and how it might affect us. And we have those that say, let's go pedal to the metal and be innovative. We're taking a cautious approach. We need to for several reasons, for safety and soundness. But there's no doubt that AI is approaching us in all different fronts, everything from an internal Bank Secrecy Act, for example, how we vet clients, doing that work more efficiently with less human involvement to do the steps that computers can do, the AI can't help us with, all the way to helping us write job reviews. I mean, it runs the gamut. AI touches us in every way, and again, we need to be cautious in how we adopt it from a client standpoint.
In fact, the non-client sensitive information that was in this deck, AI was used to build some of this deck.
Sorry to jump in again. As rates stabilize and maybe come down, are you guys seeing borrower tolerance to higher spreads increase at all?
John, you want to take that?
It goes back to the discussion we've had about deposits and that deposit push-pull on pricing. And so, this'll, thanks for teeing me up on this, Neil, I appreciate it. Because then I'll ask my question too. You got it, I appreciate it. We have so much incoming loan referrals and loan flow, and so we're always continually having these discussions. Okay, I understand the loan process. What type of relationship can we support you with? What type of deposit relationship can we draw in? And so, we all talk to people about prices dependent upon the bigger picture. What are we talking at? Obviously, you price a loan based on risk, and I rely on Scott and the team on that part of it. But then is there an operating company that comes along with this potential loan? That non-interest, the checking account that a construction company might have $1 million or $2 million into it. Now you've seen how that gets leveraged into making money for the bank. So if there's no relationship, larger deposit relationship, we'll just price those up then and in a way see how far we can stretch it. So clients there's still plenty of banks that aren't doing loans. Yes, there's some of the big banks, if it fits in their small little box, they might jump on it, but we're still seeing plenty of activity. And again, those spreads of, plus 300 over, they're out there. But I think what we excel in is speed of decision and flexibility on structure. So I'd really kind of ask all of you here, if you have friends that have operating companies, you all do, those are valuable clients to the bank. You saw the people stand up who are involved. So before you go out tonight, make sure you say, hey, I've got a friend who has this company. I'll introduce you to them. So if you do that,
paid
I
advertisement.
appreciate it. So.
Let me jump in and say that from my perspective, the answer is yes and no. Duncan has brought in his group has brought in two choice pieces of operating company business, and they are real credit users. One is $9 million out at Prime Plus One operating line of credit. So we are seeing clients get used to these spreads, getting used to these rates, and that's a great earning asset. But I also tonight heard one of our clients here in this room talk about acquiring an asset that we helped him finance, but he's got the brakes on the development project until rates come down to make it more cost effective. So we're seeing both.
Hey, Wendy, why don't you bring that mic over to Duncan? Put him on the spot. Look at that. Look at that. So, Duncan, I'm going to give you a softball. Several people have asked me, so you're moving into the north, Los Angeles, Orange County, Inland Empire. Where's the physical office? How are you bringing in these clients without a physical office? Duncan, how is that working for you, and how do you develop clients without a physical office?
Well, most of it comes from relationships and everything we have built over the years. So each one of my relationship managers is in the bank that joined my team. They've all been here and in the industry for roughly 15 to 25 years. So we haven't put an office in the market yet. Everyone is working remote, but we're relying on our COIs, our contacts, and our prior clients.
Thank you, Duncan. And it's really one of the, thank you. Give him a hand. It's really one of the aspects of our business model that is probably least understood, is very few of our clients ever physically come into a bank branch. We've been able to scale this bank almost like a virtual bank, and it's very evident in what's happening in our expansion north. There will come a time we'll put down some physical roots, but it does not deter clients' significant relationships from making us here in San Diego. Any other questions? Well, we have cocktails down below, dessert out here, and we hope you'll stick around for a while to talk to us more one-on-one. And if you're not one to ask questions publicly, we'll take the tough ones privately. Let's go. Thank you.